Hello, good evening everyone. Today also we have the revision session, and today we will revise the capital budgeting. Almost all revision we have done till now. Decision analysis already we have done, and capital investment decision. This is also called the capital budget. Professional ethics. Professional ethics is theoretical chapter. Already we have revised professional ethics as well. Capital budgeting. Only 2 questions are there. Capital budgeting, and one exam question is there, 100 questions, and it will be done on Sunday. I will revise this and 100 questions MCQs on Sunday, and if you are interested then I will share in live as well. It will be conducted within 3 hours, and there will be 100 questions, and that will be the real exam environment as well. That will be good for all those who are appearing exam this June, and I hope some of the candidates already have appeared exam, and it was started from May to, and last date will be the 30 June, and wish you all the very best for every student who are appearing for exam, and I will try to cover all the chapters before exam, and theoretical chapters already I have covered, and all total chapters. There are exam questions, 2 practice exam questions also, and there is limited time, and have to cover within the 3 hours, and I have not attempted even single questions out of these questions. There are 2 practice exams. One is 100 MCQs, second is 50 MCQs, and I will plan this one also to cover, and if you want, and I will share in live also, but normally I don't share live those exam practice questions. There are 100 MCQs. This is basically exam purpose, and other unit wise, unit 1, unit 2, chapter wise, I always share this one. Basically all these units cover in single that exam section. It is 100 MCQs, and if we able to solve all these 100 questions within the 3 hours, and definitely you will get too much confidence for each and every questions. Let me brief myself, and my name is Sabin, and I am also appearing exam for this June, and I have revised almost all the questions chapters except some of the practical exam questions, and hopefully this attempt always try to best to pass, but result we don't have control. and we can give our best. And always try to give best, always try to revise best. Okay, and now I want to revise this capital budgeting. It's been a long time I have not checked this capital budgeting chapters. There are two capital budgeting unit, I think. So let's do revision without doing any delay, because we don't have that much sufficient time. And if you are also applying for exam, then you can connect with me, and for help we can share each other ideas. Okay, this is the capital budgeting chapter, and there are only 14 questions. Okay, I think this is a easy topics, and but this unit 1 is mostly theoretical chapter as well. Don't forget to memorize all the definition also. Question number 1, there are only 14 questions, and question number 1, following decision capital budgeting technique would least like to be used in evaluating the it means capital budgeting technique normally use very less, right? Minimum used. Trade for star quarterback by the football team. No, this football team, they also need capital budgeting, because there will be the team members, and there will be the expenses, and how to make the plan, and what will the project. Accordingly, have to allocate all the budgets that will be required, and adoption of new method of allocating non-traceable costs to produce lines. This is also required, and design and implementation of major advertising program. This is also required. Acquisition of new aircraft by cargo company. Adoption of new method. This new method means this is only method, this is not a budgeting. Option B is adoption only, there is no any acquisition, purchase, decision of finance related transactions. This is not a purpose for capital budgeting. We don't need to make any decision for financial decision for this option. And acquisition aircraft by cargo company means we are purchasing cargo company. That if we are making the financial transaction decision, and they require the capital budgeting. Okay, question number 2. The terms that refers to cost incurred in the past that are not relevant to future decision. It means we already occur in past, which is not related to or relevant for decision making for future. And what is this? Simple, this is sunk cost. Okay, and this is very simple questions and simple answers. Sunk cost. Okay, and question number 3, this is practical questions. What is required? What is the appropriate end of life cash flow related to the item that should be used in analysis? We don't understand on the only reading by this requirement, right? Now we have to read the question. Core industry is analyzing a capital investment proposal for new equipment to produce a product over the next 8 years. Okay, the analyst is attempting to determine the appropriate end of life cash flow for the analysis. At the end of 8 years, the equipment must be removed from the plant and will have the net book value 0. It means that plants equipment we are purchasing, that life will be the 8 years. Okay, after 8 years there will be 0 value. The tax basis of 75,000, a cost to remove 40,000, cost to remove 40,000, tax basis 75,000. The scrap salvage value is 10,000. Course effective tax rate is 40%. What will be the end of life cash related to terms? What is saying? As per tax basis, this value is 75,000. Okay, this 75,000, and the removal cost is 40,000. And scrap salvage value 10,000 only. What will be the tax? Suppose 75,000 book value. This tax basis means book value. Okay, we need to calculate the tax. Okay, tax saving will be there. 75,000 book value, but we sell 40,000 will be removal cost, minus 10,000 will be this one, and 40%, 42, 40%. There will be loss. Removal cost 40,000, 10,000, 30,000, 75,000, 20%. 75. Not only the 75,000 is book value. Okay, minus 30,000, 45, 40%, 45,000. Net 75 minus 30, 40%, 18,000. 75 minus 10,000. This is not a loss, this is recover. Negative. This will be the cash saving. Okay. Core industry is analyzing a capital investment proposal for a new equipment to produce a product over the next 8 years. The analyst is attempting to determine the appropriate end of life cash flow for the analysis. At the end of 8 years, the equipment must be removed from the plant and will have a net book value 0. The tax basis of 75,000, cost of removal 40,000, and scrap salvage value of 10,000. is 40%. What happened? Appropriate end of life cash flow related to this item should be used in the analysis. This coming minus 40 or minus 18,000. Calculate waiting for the reply, and this one. Now question number 4. This is a very short question. The equipment replacement decision. Which one of the following do not affect the decision making purpose? We are planning to replace the old equipment by purchasing new equipment, and which the option given is not relevant for decision making. We need to just select one of the out of 4 options. Cost of new equipment, that is the relevant because we are purchasing new equipment. Okay, and operating cost of old equipment, and original fair market value of old equipment, current disposal price of old equipment. Which one is the best option? This is very simple question, and hope you understood. We all understand this one. Old equipment fair market value of the old equipment is irrelevant for cost. This one option. Okay. Now question number 5. Now question number 5. A company install a piece of equipment with a 5 years life and no salvage value. The new equipment cost 5 lakh and will generate 1,50,000 in saving each year. Old equipment with book value of 50,000 and remaining life of 2 years was sold for 20,000. No change in working capital are anticipated. The effective decision income tax rate 40%. That is the total investment for the new equipment is how much outflow. We have to calculate the outflow. New equipment cost 5 lakh. This is simple. And saving up old equipment book value 50,000 remain 2 years, was sold for 20,000. Book value was 50,000 and sold was 20,000. Is sold on loss. And 50,000 minus 20,000. 20,000 will be tax saving. Tax saving 40%. Tax saving 12,000. Tax saving on loss on sale of equipment 12,000. Okay. Loss 20,000 and minus 5 lakh. It's come 4,68,000. Okay. This is very simple question. Our depreciation tax shield is what? Depreciation tax shield. Anybody knows this one? If you are a student, please comment. And this is a very simple question. Tax shield. Tax shield is simple. Saving or depreciation is called tax shield. Okay. Depreciation tax shield means suppose I have a fixed asset and annual depreciation will be there as per accounting policy, whatever policy adopted by the entity, that depreciation saving on tax saving on that depreciation portion is called tax shield. Okay, suppose there is a depreciation 50,000. Okay, 50,000 depreciation. Suppose tax rate is 40%. In this case, suppose 50,000 depreciation and 40% tax. In this case, tax shield will be 20,000. It means we are saving on depreciation. That is tax. That is shield. Means we are saving due to depreciation expenses. Okay. Tax expenses caused by depreciation or reduction in income tax. After tax, cash outflow, cash provided by recording depreciation. Tax expenses caused by depreciation. This one, reduction in income tax, is a perfect answer. Okay. Now question number 7. What is the requirement of this question? Assuming 40% marginal tax rate, the expected net cash flow from the project in the 10th year. There is a project. Okay, we have to calculate cash flow for the 10 years. Okay, let's read the question properly. Garfield Inc. is considering a 10 years capital Okay, Graphil INC is considering 10 years capital investment project with forecasted revenue of 40,000 per year. Revenue will be the 40,000 per year and forecasted cash operating expenses will be 29,000 per year. Okay, simple. Revenue minus expenses will be net revenue. Okay, the initial cost of the equipment for the project is 23,000 and the Graphil expected to sales equipment for 9,000 at the end of the 10 year. The equipment will be depreciated over the 7 years. It means book value will be 0. The project require working capital investment. Working capital also requires 7,000. That is inflation. Beginning requires 7,000 working capital. At the end of the 10 years, it will also retire, and we have to calculate as per the time value. Okay, and other 5,000 at the end of the 5 years. At the beginning, working capital required 7,000. Okay, at the end of the 5 years, is required 5,000 working capital. Assuming 40% income tax, cash flow we have to calculate here. Okay, this one is practical questions, but there is not a hard to solve this question. Simple. First we have to calculate net revenue. How much net revenue is coming here? Net revenue is coming 40,000 minus 29,000. It's coming 11,000 net revenue per year. Okay, and it will be for the 10 years. And equipment project, initial cost of the equipment project one is the working capital 5,000 will retire, and 11,000 will be the net revenue. This is simply, see, we have to calculate cash inflow at 10th year. It means 10th year means after 10 years what will be the cash flow. That means just we need to calculate the revenue plus, and that working capital 5,000 that will retire. Okay, and there will be the tax and on tax on sale of equipment. 9,000 will be the sale, but depreciation that tax will applicable 40% and multiply by 6. It comes to 5,400 from sale of equipment plus 5,000 from the retirement of working capital plus 11,000 from the regular yearly revenue. Okay, it is coming total, there is, and it is 11,000. Okay, then expected net cash flow from the project in the 10th of year 11,000, and equipment project zero depreciation 170, and 7,000. Another 5,000, 12,000 plus, and another 5,000 and 5 year as well. 11,000, 23,000 plus, $9,000, 32,000, but tax not applicable. It's coming 32,000. Graphite INC is considering 10 years capital investment project with forecasted revenue of 40,000 per year and forecasted cash operating expenses 29,000 per year. The initial cost of equipment for the project is 23,000 in graphite expenses to sell the equipment for 9,000. At the end of the 10th year, the equipment will be depreciated over the 7 years. The project requires working capital investment 7,000 at its inception and another 5,000 at the end of the 5 years, assuming 40% marginal tax rate. Expected net cash flow from the project in the 10th year is it's coming 32,000. Let's check. In fact, this question is not properly given, and that should not be round up figure because we are saving tax as well. Tax as well 5,400, and the answer will be and 7,000 will be working capital, 5,000 will be working capital, and 11,000 will be the net saving, and that will be 23,000. And another that sale of fixed asset is coming 9,000, and tax will be the 40%, and tax need to be paid 40% and 36. Okay, and 9,000 multiplied by 0.6 is coming 5,400 plus 2,300,000 is come to 28,400. This is coming the answer, but this is not a correct answer. Now question number 8. Which one of the following statement concerning cash flow determination for capital budgeting process is not correct? Right? Cash flow determination for capital budgeting purpose. Okay, net working capital changes should be included in cash flow. Yes, this we need to calculate. Just before question we just solve one question that 5,000 required at the end of the 5 years, right? The same thing. That is a change of working capital requirement, and after 5 years require additional 5,000. That's why changing working capital we have to consider for the capital budgeting purpose, and this is correct answer, not this is not incorrect question. And option B, book depreciation is relevant because it affects net income. Depreciation is also relevant because we can save depreciation tax on depreciation value, that will be relevant. Depreciation must be considered because it affects the cash payment for taxes. Some costs are not incremental and should not be included. Yes, some cost. Some costs should be eliminated. Some costs not relevant for the capital budgeting decision making. Now question number 9, sensitivity analysis is used for capital budgeting. 2. What? Sensitivity means how much sensitive the decision. One decision making, how much effect will to other option. That's sensitivity. Itself, one decision itself not a sensitive, but how much that will affect the other option, that will be the sensitive. Okay, and sensitivity simulate probabilistic customer reaction to a new product. Option B, estimate a project internal rate of return. And option D, determine the amount that variable can change without generating unacceptable result. Option D, identify the required market share to make a new product variable and product acceptable result. Sensitivity analysis. Nobody is answering, nobody is talking. sincerely denies it. Question number 10. What is the estimated total investment for this expansion? Lawson Inc. is expanding its manufacturing plants, which require an investment of $4 million in a new equipment and plant modification. Lawson's sales are expected to increase by $3 million per year. Result of expansions: can investment in current asset average 30% of sales, account payable and other current liability 10% of sales. What is the estimated total investment for this expansion? We need to calculate the investment amount. For this one, already we discussed. For capital budgeting, working capital also need to be considered, right? And 4 million is that new equipment cost, and plus and other working capital required. Okay, and working capital current assets required how much? 30% of sales how much? 3 million. 30% how much? 3 million is sales, and 30% how much? 3 million. 30% come to 9 lakh. Okay, 0.9 million you can consider. And other current liability how much? 10% of the sale, and 3 million is sales, and 10% how much? 0.3. And working capital how much required? 0.9 is the current assets, and current liability how much? 0.3. Okay, 0.3. It's come to 0.6. And 4 million is the equipment cost, and working capital requirement is 0.6. How much? 4.6 million. Simple. This question answer is given there. Okay. Now, and question number 11. All of the following are example of inputted cash cost except all of the following are an example of inputted cost except option A declarated depreciation, option B assets that are considered absolute that maintain a net book value, option C the stated interest paid on bank loan, option D lending fund to a supplier at a lower than market rate in exchange for receiving the supplier product at discount. Now we have to understand the concept here. Imputed cost means what, right? First we need to understand the imputed cost. Imputed cost, do we know the notional cost or hypothetical cost? Do we know hypothetical cost? or notional cost. That is called imputed cost. Imputed may be confused, but notional cost and hypothetical cost we know. That is very simple. And while decision making, but do not involve actual cash outflow. Hypothetical, okay? Imputed means which do not involve actual cash flow. That's called imputed, okay? In this case, which is the hypothetical more options? Depreciation, not the hypothetical. And option B, assets that are considered absolute that maintain in net book value. Absolute means that is not a usable, okay, since long time is lying on store, like that. Option B is correct answer. Other are not a correct answer. Option A, this is imputed non-cash depreciation is recorded. Now in question number 12, Regal Industries is replacing a grinder purchased 5 years ago for 15,000 with a new one costing of 25 in cash. The original grinder is being depreciated on straight line basis over 15 years to zero salvage value, and Regal will sell this old equipment to third party for 6,000. The new equipment will be depreciation on straight line basis for over 10 years to zero salvage value, assuming 40% of marginal tax rate. Net cash investment at the time of purchase, if total grinder is sold and new purchase. Do we understand here what is saying this question? These questions require what will be the cash flow at the time of purchase of this new machine grinder, okay? What if 25,000 cash? This is simple. Another, what will the inflow? 6,000. We will sell that old grinder for 6,000, but we need to consider here whether tax is applicable or not. Right? And 15 years life is 15 years. 15 years means 15,000 divided by 15 years means 1,000 per year, and we are considering at the 5 years, right? 5 years means 5,000 already depreciated. 15 years, 15 minus 5, how much? Book value is 10,000, right? Book value 10,000. 15,000 was the original cost, and 15 years is the life of the asset, and per year depreciation how much? 1,000. And Regal Industries is replacing a grinder purchased 5 years ago, means still this asset has a life 10 years remaining, right? 10 years remaining means 10,000 book value, but we are selling on 6,000. 6,000 selling, it means loss. We are selling on 4,000 loss, right? If we are sell on loss 4,000, there will not be tax, okay? Tax will not be there. there will be 4,000 loss, there will be tax saving for loss. How much? 1,600 tax saving. Okay, loss on sale of fixed asset 1,600. Don't forget that one. Okay, 125,000 will be the cost, minus 6,000 will less. This will cash inflow on sale of old equipment, equal to 19,000. okay, 19,000 minus tax saving on loss of sale of equipment 1,600, and it's equal to 17,400. okay, this is very simple. okay, now in question number 13. okay, the tax impact of equipment depreciation affects capital budgeting decision. Currently, the modified accelerated cost recovery system MACRS is used as the depreciation method for the most assets of the tax purpose. The MACRS method of depreciation for the asset with 3, 5, 7 and 10 years recovery period is most similar to which one of the following depreciation used for the financial reporting purpose? This is 200% declining balance, sum of the years digit and units of production and straight line basis. This is concept and theory based, and we need to remember this one because this answer is question number A. This one you need to remember, we need to remember for the exam purpose. There is no exactly meaning, but if you want to concept for this one, why question number A, then normally MACRS, this is a depreciation method normally used in the US, and other country don't use this much, and suppose India, UAE, other Asian countries normally use the straight line basis or WDB method, and this MACRS is normally used in US for the income tax calculation purpose, right? And already MACRS used for the tax purpose and allow the companies to depreciate more in the early years of asset lives. It is an accelerated depreciation method, meaning it reduce the asset value faster in beginning. Okay, the financial reporting depreciation method mentions that is answer is 200%. Why 200% declining balance method? Like MACRS, the 200 declining balance method depreciates more in early years and less in later years. That's MACRS for 3, 5, 7 and 10 years. Use as version of 200% declining balance method, which is later switch to straight line in some cases, right? Now in question number 14, what is the requirement? What is the net cash outflow at the beginning of the first year that more corporations should use capital budget analysis, cash outflow at the beginning of the year. Okay, the more corporation is considering the acquisition of a new machine, the machine can be purchased for $90,000. It will cost $6,000 to transport to more plant and $9,000 to install. It is estimated that machine will last 10 years and it expected to have estimated salvage value $5,000. Over the 10 years life, the machine is expected to produce 2,000 units every year with a selling price of 500, combined material and labor costs $450 per unit. Federal tax regulation permit machine for this type to depreciate using the straight line method over the 5 years. No estimated sale value. More has margin tax rate 40%. Do you know? This question is just making the drama. Means the question is lengthy, but what is the exactly requirement? Exactly requirement is only the amount to be paid at the beginning of the year. Means while we are purchasing, how much cost? Purchasing cost 90,000 plus the transport cost 6,000 plus plan, that is transfer car, and installation cost how much? 9,000. Simple, that's all. How much? Simple, this one question is. But question is saying this, that, income and depreciation, everything. But requirement is only the beginning cost. Okay. Now all question is solved, but out of this there are 2 or 3 confusing questions. Maybe that we need to revise 2 or 3, and we can submit this one. 2 or 3 questions are confusing, I know. We need to check. There are around 4 question mistake there. 4 question are mistake, which are in mistake there. You can check here. All question also given here. Question and answer, why, and with reason. There are 4 question mistake. One, this one. Already I told you there was some conceptual error here, and 1, 2, 3, and another one is incorrect. This one. Mainly theoretical question is mistake there. Now we can see here answer with the correct answer is given, and if you want reason also there. Okay, and which one is wrong? This one. You can see here answer also given detail. Okay, and this one also question. This is simple. This was the clerical mistake, and we did not properly read the requirement. That is only. These are the very simple, and this one is the confusion question. This sensitive analysis, and this was not a confusing question. This was silly mistake, this one, not a confusion. This was the whatever we select the question answer, this was the silly mistake, not a confusion type. But this one is the confusion type surely. This one question. And other questions are simple. All other let's do next. Now this is next unit of this same questions, the same chapter. This is unit 2 of this capital budgeting, also called decision making, investment decision making. And the question is given the net present value. Do you know net present value? Net present value method, that method net present value is normally suppose we invest in a plant, and today I invest suppose 1 million, and while I'm making the decision and what will be the future cash flow, the future cash flow, suppose per month, per annum I receive 2 lakh cash inflow, and today as of now I have to invest 1 million, that's 10 lakh, and per month per annum I need 200 lakh, and that will continue up to next 7 years. And what will be the present value of that cash inflow? That if I future cash inflow that future cash inflow discounted, applying the discounted discounted method, means suppose given the required rate of return, interest rate, market rate, discounted cash flow, that's also discounted cash flow, and I receive 2 lakh after 7 years, that for today what will be that value? That is called net present value. Suppose 2 lakh I receive in 7 years, and I will calculate today's value of that 7 years by applying the discounted cash flow method. And 2 lakh every year means I receive end of this year and next year, every year I will receive. And what will be the today's value? Today's value, suppose coming 9 lakh, and I have to invest 10 lakh, that will be the negative NPV, right? Net present value, that will be the negative. More investment required than net cash inflow, right? That's why that decision will be rejected, that decision will not be accepted, because when I am investing any project, I always expect that my required rate of return should meet that investment purpose, then only I will invest in that project, right? I will have the certain required rate of return, and on the basis of that required rate of return, and what will be my cash inflow, and I have to calculate as of now. If the cash inflow is positive, then I have to accept, that is profitable to me, right? But if cash inflow is negative, then I have to reject that project. That is the importance of this NPV. And for decision making, I have to calculate NPV, and if there is NPV is coming positive, then I will accept that project. Normally, if you are the working professional, every company, such kinds of projects, such kinds of decision is normally happening, right? And we have to give a proper decisions to management, and that's why this NPV is very much important day-to-day working environment as well. Now let's check this question number 1. The net present value, NPV method and internal rate of return, IRR method are used to analyze capital expenditure. The IRR method is constructed with NPV method. Option A is preferred in practice because it is able to handle multiple desired hurdle rate, which is impossible with the NPV method. Assume that the rate of return on the reinvestment of the cash proceeding is at the indicated rate of return of project analyzed rather than the discounted rate used. Is considered inferior because it fails to calculate compounded interest rate. Is incorporate the time value of money where NPV method does not. Question number option D is the direct incorrect. Option D, first of all we have to eliminate this option. Okay. one method we need to also understand an IRR, internal rate of return. IRR, while we are applying for decision making, IRR normally consider that reinvestment rate of return also same rate. Okay, same rate means whatever the IRR rate, the same rate reinvestment rate also will be the applicable rate. That's why reinvestment rate will be the same, and this option B is the correct answer and other options are not correct. Now question number 2, capital investment project include proposal for all of the following except. I think already we discussed this question in previous section also, and capital budgeting is required for the long-term investment only, and during the long-term investment, if there is require some changes in working capital, then that need to be considered. But for financing, other working capital requirement, loans, all these decisions do not considered by this capital budgeting. This is working capital requirement. These are not a part of this is capital budgeting decision making analysis. And then here is option A, expenditure for the product offering. This is relevant. Option B, acquisition of government mandated pollution control equipment. This is also capital budgeting related. And option C, additional research and development facility. This is also relevant for capital budgeting. And this refinancing existing working capital requirement, this is not relevant for that capital budgeting. Okay, now we are in question number 3. Okay, we are in question number 3. I think there are given option X, Y, Z, W. Okay, option, there are 4 options are given, and investment given, X of investment given 39,50,000, option Y given 30 lakh, option Z given 20 lakh, option W given 8 lakh. Okay, and present value of cash flow at 16%. Cash flow how much? Present value 38 lakh. 38 lakh means what? Do you know? This one very easy. Present value also given there after calculating. What we did? Because see, option X already negative NPV. See, cash investment means outflow 39,50,000, and inflow is given 38 lakh. This is negative. Y option is given, that is positive. Positive how much? 7,50,000 positive is given for Y option, and Z option given, that is also positive. How much? 8,25,000. Z option. And W option is also positive. How much? W option positive 3 lakh. Okay, in this case, which one is the best? When there is a given IRR and PV option, please remember this one is a one concept, entire formula, entire capital budgeting decision analysis will be applicable. Okay, while there are 2 options is given, this NPV and IRR. Which will be the best option to select? Always go for NPV. If there is a best NPV, greater NPV, then always select that option is a good. Even suppose here is given best NPV, which option? Option Z, because there is the highest NPV, 8,25,000. Okay, and option Y, 7,50,000, W 3 lakh, X is negative, X is rejected. All other options are accepted, but if the option is mutually exclusive. Do you know mutually exclusive means? Mutually exclusive means if you are selecting one option, then other option you should let go. Means you cannot choose the other option. This case, this is a mutually exclusive option. Here is given mutually exclusive, and this is a mutually exclusive, and only one option you have to select. And if there is only one option and NPV and IRR, best whichever is higher NPV, go for that option, not IRR. Okay, because IRR is not best decision making for capital budgeting purpose also, because IRR always consider the reinvestment rate same as IRR, but NPV consider discounted rate. That is a different. And which option is a best option? Option Z. Okay, because option Z having the highest NPV. Okay. Now in question number 4, we are in question number 4. Company is in the evaluating situation of the having unlimited capital. Unlimited capital. See, here is another concept, new concept. Suppose there is a unlimited capital is there, then we can select all the projects, those who have the positive NPV. Okay, unlimited capital. Best decision rule in economic sense for it to follow would be to invest in all projects in which the net present value is greater than 0. Net present payback period greater than return, accounting rate of return, other option colors. Rate of return. Net present value is greater than 0, then accept all the project. If there is a unlimited capital fund, there is no hurdle, there is no limited capital, unlimited capital. Whichever project has a negative positive NPV, invest. Right? Now question number 5. Same question given, internal rate of return and NPV given. Already I told you, if there is a IRR and NPV option is given, always go for NPV, because NPV is better than IRR for decision making. Okay. Project A, project B, project C given, net present value also given, net present value 20,680, and option B 30,300, option C 15,000. Okay. Company expect minimum net present value 20,000 from the project. Absolute projects. The projects are mutually exclusive. Mutually exclusive already we discussed. One project select, another project should be eliminated. Okay. And where all cost of capital 8%, which one of the following should the controller recommend the president? Option B, highest NPV, right? Project B because the highest NPV, option B. Okay, we go for option B because projects are mutually exclusive. If we select one project, another project will be automatically rejected, right? Mutually exclusive, already given mutually exclusive. And then whichever project having the highest NPV, go for that one, because project B is having 30,300 NPV, then go for NPV. Okay, now in question number 6, the question number 6, Bennett INC. First we have to go for the requirement of the question. They are given year 1, year 2, year 3 and year 4. Project X, project Y given. Project 1 X, year 1, year 2, year 3, project Y, year 1, year 2, year 3, year 4 is given. Okay, assuming the adequate funds are available, it means no capital rationing. Capital rationing means, do you know? Capital rationing means the limitation of the capital is called capital rationing. Okay, assuming that adequate funds are available, which of the following projects option would you recommend that Bennett management undertakes? Okay, let's read the question in turn. Bennett INC used the net present value method to evaluate the capital project. Bennett required rate of return is 10%, and Bennett is considering two mutually exclusive projects for its manufacturing business. Okay, mutually exclusive means one accepted, another automatically rejected, right? This concept always should be followed. Okay, both projects require an initial outlay 1,20,000 and are expected to have a useful life of 4 years. The projected after tax cash flow associated project as follow. Okay, initial outlay how much? 120,000. Okay, both project 120,000. Okay, and total inflow how much? 160,000, 40,000, and project Y is 120,000 minus 170,000, 120 minus 170,000, 50,000, 40,000, and both are positive NPV, right? Both are positive NPV for both. As a both project X and Y. Simple. Don't reject anyone. Exclusive, mutually exclusive, two mutually exclusive project. Then go for Y only. Okay. Question is mutually exclusive. Don't forget to read question properly. These two projects are mutually exclusive. That's why we are going for higher NPV, because NPV higher is project Y. Okay. Now in question number 7, sensitivity analysis used for project capital. This is repeated question. Do you know? Earlier also the same. This is saying the sensitivity analysis is used with capital project. Option A is a technique used to rank capital expenditure request. Option B is a what if technique that asks how given outcome will change if the original estimate of capital budgeting model are changed. And option C measure the change in discounted cash flow when using the discounted payback method rather than the net present value method. And option D is used extensively when the cash flows are known with certainty. This is repeated question. Okay, last time we did mistake, but this time we have to think this one. Okay, sensitivity analysis is what if technique used to evaluate how the change in one variable such as sales, cost, discount rate affect to outcome like net present value, internal rate of return of the capital project. It helps in assessing the risks and robustness of the investment decision, right? This concept we have to apply. Where is this concept? Option A is the not correct. Option B is what if technique that asks how given outcome will change if original estimate of the capital budgeting model are changed. Then option B is the correct, right? Now question number 8. Now in question number 8, the net present value method of investment project analysis assumes that project cash flow are reinvested at what? Already we discussed. This is very simple. What is the main difference between IRR and NPV? Already we discussed. NPV always reinvested at the discounted rate. IRR reinvest at IRR rate. There is a main difference. Suppose IRR rate is 18% and discounted rate is 12%, and IRR assumes that reinvestment rate also again 18%, okay, and NPV assumes that reinvestment rate will be the discounted rate only, that is discounted rate. This discounted rate is option A is there. Option A is option. Okay. Now in question number 9. Question number 9. Which one of the following is the most appropriate time period for the capital budgeting for evaluation of capital investment? A company operates on a calendar years but maintain four continuous quarterly budget for up-to-date budget information. Okay. After completing its 5 years long-term plan, the company's management is deciding to make a capital investment in new equipment. The equipment is expected to have useful life of 9 years. Means 9 years, simple. 9 years means 9 years. Okay. Question number 10. Now we are approx at 50% of the total questions. Hopefully you will doing great for this capital decision making, and this is some technical question, technical chapters as well, and if you able to cope this capital budgeting chapter, definitely easily you can cover other chapters. Okay, this is some technical questions, and technically we have to think to solve the questions, and there is a more conceptual questions as well. And but benefit is this is normally practical, and we normally use in day-to-day office. And question number 10. The ranking of mutually exclusive investment determined using the internal rate of return and net present value may be different when. This question also tricky. Okay. The ranking of mutually exclusive investment determined using the internal rate of return and net present value method may be different when multiple projects have unique life and size of the investment for each project is different. The required rate of return higher than internal rate of return of each project. And option C, the lives of multiple projects are equal and size of required investment are equal. Option D, required rate of return equal the IRR of each project. This option D and option C is not correct. Simple. Please remove. And option A mostly correct can be happen, because option B is not relevant of this question. Option A, why correct? The key difference between IRR and NPV is IRR does not consider scale of investment, project life directly, right? NPV is better suited for the comparing different size and different length of project. Main difference is this one. That's why. Option B, what is saying? Required rate of return is higher than IRR of his project. If required rate of return is higher than IRR, then both method will reject all projects, so no conflict ranking, right? And option C is not correct. Why? Because if both life size are same, IRR and NPV will generally given consistent ranking unless there is an unusual cash pattern, right? And option D, if the required rate of return and then if a required rate of return is IRR, then NPV becomes 0. All project, then both method will be indifferent, no conflict, right? That's why option A is the correct answer. When there are multiple projects have the unequal lives and size of investment for each project are different, in that case NPV is better option than IRR. Okay, because IRR does not consider the scale of investment or project life directly, and NPV is better suited for the comparing different size, different length of project, even unique project. Okay, that is the main reason. Now in question number 11. Question number 11, let's discuss on this question. This is also technical. Okay, the chief investment officer is performing an analysis to determine if her firm should invest in new equipment to produce a product recently developed by her firm. The option would be abandon the product. She use the net present value method and discount it at the firm's cost of capital. Chief investment officer is contemplating how to handle the following items. Number 1, the book value of warehouse space currently used by another division. Interest pattern. Question number 2, interest payment on debt to finance the equipment. And question number 3, increase level of account payable and inventory. 4, research and development spent in prior years and treated as a different deferred asset for book and tax purpose. Which of the four above items are relevant for Chief Investment Officer to consider in the determining cash flow for NPV calculation? Option A, number 2, number 3 and number 4 only. Option B, number 3 only. Option D, number 1, number 2, number 3 and number 4. And option D, number 3 and number 4 only. And NPV method, okay, book value warehouse one thing is we never don't forget while calculating NPV, always we consider only the incremental cash flow. Those changes as a result of investment decision are relevant. Okay, sunk cost and financing cost are not included project cash flow. This is the fundamental rules. Okay, then book value of warehouse space currently used by another division. This is not relevant for decision making, right? Book value, this is not relevant. This is not relevant for decision making. Book is sunk cost and does not affect cash flow. However, the space would be purpose, repurpose, opportunity cost. It may market value might be relevant but not book value. Okay, that may be the market value will be relevant but book value will not be relevant. Option A is already rejected. Option B, interest payment on debt, finance and equipment. Interest, what is the relevancy of this one? Because interest payment, financial costs are not part of project cash flow, right? They are considered in the discount rate cost of capital already included there. Including them would be the double consideration, right? Already we have considered finance cost while making the discounted rate. Again, if we start to consider interest, other things, this is that, then there will be the double consideration. Then that is why this we have to remove this one. And 3 number, level of accounting availability inventory. Okay, payable, inventory, these are relevant working capital items, right? That's why we have to consider this one. Or thought is relevant. Why? This is a working capital item, affect the cash flow. Using in inventory already available reduce the need for additional cash flow outflow, right? And question number 4, research and development is spent in prior years treated as deferred asset, not relevant. This is our sunk cost, we already discussed. This is past cost and this is sunk cost, not relevant for the decision making. This is a sunk cost, even though it's a deferred asset for the accounting is already incurred and do not impact future cash flow. That's why which one is only relevant? Option third. Option third is there, only third. Okay, this is the option. Now question number 12. Olson industry need to add a small plant to accommodate a special contract to supply building material over 5 years period. The required initial cash outlays at time 0. Time 0 means today are as follow: land 5 lakh, new building 20 lakh, equipment 30 lakh, right? Olson's uses straight line depreciation method for tax purpose and will depreciate the building over the 10 years and equipment over the 5 years. Olson's effective tax rate 40%. Revenue from the special contract are estimated 1.2 million annually, and the cash expenses are estimated at 3 lakh annually. At the end of the 5th years, the assumed sales value of land and building are 8 lakh and 5 lakh respectively. It's further assumed that equipment will be removed at cost 50,000 and sold for 3 lakh. As Olson utilized the net present value method and to analyze the investment net cash flow at period 3. Period 3, for only 1 year cash inflow we need to calculate. Period 3, this is 5 years and 10 years. For this one, what we need to calculate first? Annual revenue. Okay, question is too lengthy, but requirement is too short. Only 1 year inflow we have to calculate. Annual revenue how much? 1.2 million given. Okay, cash expenses how much? 3 lakh given. How much? Net 8 lakh. Okay, how much depreciation is there? Depreciation will be there. How much depreciation? We have to calculate depreciation. depreciation, how can we calculate? Building given 20 lakh for 10 years. How much per year? 10 years, 2 lakh. And equipment 30 lakh. And how much time, how many years? Like 5 years. And how much depreciation per year? 6 lakh. Total depreciation per month how much? 8 lakh. And revenue how much? 12 lakh. And depreciation how much? 8 lakh. And other cash expenses how much? 3 lakh. Net revenue how much? 1 lakh per year. Tax how much? 40%. And after tax how much? 60,000. And depreciation is not a cash flow, okay, that need to add it back. How much cash flow? 8,60,000. okay, 8,60,000 will be the annual cash inflow, right? Simple. If you are confusion, you can ask in questions, right? Very simple. See, already given land and building there, equipment given, building 20 lakh, equipment 30 lakh, equipment 5 years, straight line method, building 20 lakh, straight line method, 2 lakh depreciation for building, 6 lakh depreciation for equipment, 8 lakh, and 3 lakh cash expenses, total 11 lakh, and 12 lakh is the revenue, minus 11 lakh expenses. 1 lakh will be the net income. Net income will be how much? Tax will be the 40%. And after tax how much? 60,000. And depreciation is not a cash expenses, right? That is why we have to add back depreciation. And depreciation how much? 8 lakh. 8 lakh plus 60,000 how much? 8,60,000. Which option is given here? 8,60,000. That's all. Okay, 8,60,000. okay. Now in the question number 13, and we have given cash operating cost and required rate of return. Okay, required rate of return, cash operating. Option A, adjusted for inflation. Option adjusted for inflation. Option 2, adjusted for inflation, do not adjust for the inflation. Third, don't adjust with the inflation, adjust with the inflation. Fourth, don't adjust with the inflation, don't adjust with the inflation. Okay, now let's read properly the question. Sarah Watson's has prepared a net present value analysis for 15 years equipment modernizations program. Her initial calculations include a series of depreciation tax savings, which are then discounted. Watson's is now considering the incorporation of inflation into NPV analysis. If the depreciation tax saving were based on original equipment cost, which of the following options correctly shows how she would handle the program cash operating cost and forms required rate of return respectively. Option 1, operating cost and required rate of return. Option 1, adjust for the inflation. Option required rate of return, adjust for the inflation. Option operating cost, adjust for the inflation. Required rate of return, don't adjust for the inflation. Option cost, cash operating cost, don't adjust for the inflation. Required rate of return, adjust for the inflation, and cash option don't adjust for the inflation, required rate of return don't adjust for the inflation. Now just analyze the question. Adjust rate of inflation. If the depreciation tax saving were based on original equipment cost, which of the following is option is correctly shown? The handle of program cash operating cost in forms required rate of return respectively. Cash adjust with the inflation, required rate of return don't adjust with the inflation. Option first. Okay, now question number 14. If income tax consideration are ignored, how depreciation handled by the following capital investment analysis technique? Internal rate of return and payback period. Option A, internal rate of return excluded, payback period excluded. Option second, internal rate of return excluded, payback period included. Option third, internal rate of return included, payback period excluded. Option 4, internal rate of return included, payback period excluded. These both are question same. Now we have to analyze the concept here. First, payback period. We have to understand payback period means when we invest capital in a project, and at what time, what year, month we can recover that amount. Suppose I invested 1 million, at what time I can receive back that 1 million? That is determined by payback period. And payback period option we have to select as soon as possible, whichever is shortest period to recover that initial investment amount, that we have to select. Okay, now concept. If income tax consideration are ignored, how is depreciation handled by the following capital investment analysis technique? The key is to understand how each method treats depreciations when tax are ignored. Okay, please listen carefully. The key is to understand how each threats of depreciation when tax are ignored. Payback period focus on inflow only, depreciations is excluded. Internal rate of return uses cash flow, depreciation is excluded unless tax are considered because depreciation affect taxable income. Accounting rate of return based on accounting income, depreciation is included. Net present value method uses such as depreciation is excluded unless tax savings are included. Suppose if there is no concept of tax, then depreciation no need to consider anywhere, because no tax, no depreciation. We consider depreciation only for the purpose of tax saving, right? Let's match the option. Option 1. Payback period exclude, internal rate of return exclude. If we ignore the depreciation, then option, which one is correct? Option 1, right? Simple. Now question number 15. Which of the following decision capital investment analysis technique would be least likely be used in evaluating? Means the question is saying, of the following decision capital investment analysis technique would least likely be used in evaluating technique. This is the repeated questions. Earlier also we did the same questions. Okay. Trade for star quarterback by the football team. The same question repeated. This one is included designing implementation of major investment program. This is included adoption of new method. This adoption of new method is not included. The same, this is question repeated question, so I did not spend time to here. Now question number 16. The technique the capital investment analysis model that is generally considered the best model for long range decision making is the capital investment analysis model that is generally considered best for model for long range of decision making. Payback period, and accounting rate of return model, adjusted rate of return model, discounted rate of cash flow model, discounted cash flow model. Which one is the best option? Let's read the concept, why and which. The capital investment analysis model that is generally considered best model for long range of decision making is option A, accounting rate of return model, option B, payback period model, and option C, unadjusted rate of return model, option D, discounted cash flow model. Okay. Yeah. already I discussed some parts about the payback model. What payback model says, payback model will be the best. This will consider best those investment which gives as soon as possible the initial investment amount. It means suppose payback period, one project has a payback period 3 years, another project has a payback period 5 years, but that payback period 5 years has a NPV 10 lakh, and payback period another option having 3 years is having NPV 8 lakh, but payback period always go for 8 lakh because that payback period has shorter than 10 lakh. That is why this is not good for long term. That's why payback period is not a correct answer. And accounting rate of return model, this is not a concept in capital budgeting. And option C on adjusted rate of return model, this is not a concept in capital budgeting or this calculation making decision. And only option is correct, option D remain discounted cash flow model. Why discounted cash flow model is correct, I will explain you. Discounted cash flow model is generally considered the best model for the long range decision making because it takes into account the time value of money. Main thing is this one, time value of money. Means if we invest our capital for long term and if we are calculating NPV is positive, then that NPV consider the all time value of money, that is a part of interest, right? And consider future cash flow over the life of investment and provides more accurate picture of investment to profitability over the time. Already discussed other model like accounting rate of return, payback period, and unadjusted rate of return. Ignore the time value of money. They don't consider the time value of money, they just consider the as soon as possible recovery of the initial investment. Okay, that is why we always go for the discounted cash flow model, right? Now in question number 17, okay, during a presentation on non-discounted cash flow model for capital budgeting decision, an analyst model that following two statements concerning the payback method. Statement 1, it is the best decision criterion for accepting or rejecting the project. Option 2, it may be encourage excessive investment in short-term project at expenses of investment in long-term projects. The analysis is correct regarding option A, neither statement 1 is nor statement 2. Option B, statement 2 only. Option C, statement 1 only. Option D, both statements are correct. Now see, this payback period never be the best. Okay, already we discussed. Then option A is rejected, and then what option remain? Only 2. Option 2, simple. Payback period never we consider the best option to make the capital investment decision. We always go for the NPV method. Then how can we say that this is the best option decision making for criteria? Option is rejected, then option 2 only. Simple. Okay. Now in question number 18, okay, Now go for question number 18. The owner of Wafi video rental cannot decide how to project the real cost of opening a rental store in a new shopping mall. The owner knows the capital investment required but is not sure of the return from the store in new mall. Historically, the video rental industry has had an inflation rate equal to economic norm. The owner require real internal rate of return 10%. Inflation expected to be 3% during the next few years. The industry expects new store to show a growth rate without inflation 8%. First year revenue at new store expected to be 4 lakh. The revenue of second year using the both real rate approach and nominal rate approach will be respectively option A 4,40,000 real and 4,53,200 nominal, option B 4,32,000 real and 4,52,000 nominal, option C 4,32,000 real and 4,44,960 nominal, option D 4,40,000 real and 4,52,000 nominal. Here we have to calculate real rate approach and nominal rate approach. We have to know about this approach, what is the real rate approach and what is the nominal rate approach. Okay, but also we have to consider that both real rate and nominal rate have to calculate at second years only. Here is a question required second years only. Okay, expected real revenue growth 8%, inflation rate 3%. Real revenue in year 1 will be assumed baseline real revenue, that is 4 lakh given is year 1, and since 4,40,000 is second year real revenue in one of the option, this is given, this is the 4,40,000 real revenue. What will be the real revenue? Real revenue will be the year one. Okay, we are year 1 is 4 lakh real revenue, and growth rate how much? 8 means 1.1 plus 8%. 1 plus 8% will be what? 1.18 multiplied by 4 lakh is 4,32,000. Okay, 4,32,000 real revenue will be the second year. Okay, where is the 4,32,000? The option C and option B. 4,42,000. Okay. And nominal revenue, how can we calculate? Nominal revenue is calculated by multiply by the real revenue multiply by the inflation. Suppose real revenue 4,32,000. Okay, what is the inflation? Inflation is 3%, means 1.03 multiplied by 4,32,000 is come to 4,44,960, and option C is the exactly matching. Okay, very simple. Any issue? No issue, right? Real revenue is the one multiplied by growth rate. It means suppose year 1 is 4 lakh revenue, okay, and year 2 what will the revenue? 4 lakh multiplied by growth rate. Growth rate means 8%, means 1.08 multiply is come to the 4,32,000, and nominal will be what? Real revenue multiplied by inflation is the nominal rate, and it's come to the 4,44,960. Okay. Now in question number 19, this is question number 19. An advantage of net present value method over the internal rate of return model discounted cash flow analysis is that the net present value method use the discounted rate of return discounted cash flow with outflow can be used where no constant rate of return required for each year of the project. Use discounted rate cash flow where internal rate of return model does not. Compute the desired rate of return for capital project. Option D is not correct. And question number A also not correct. Question B and C we have to consider. Okay, B can be used. There is no constant rate of return required for each year of the project. Option B also correct. Use discounted cash flow where internal rate of return model does not. Internal rate of return do not use the discounted cash flow. IRR use. Option B and C. B. Okay, C. We go for C, not B. Now, question number 20. What is the question number 20 exactly? CFO of a company concerned about the impact that inflation will have on the company reported financial results and wonders whether sales will comparable from year to year. The company had sales of 5 lakhs in year 3 and the price index for this industry has raised from 200 in year 3 to 220 in year 4. The level of sales that the company must reach in year 4 to achieve real growth is 15%. Real growth. What is the real growth? Just we have calculated before. Real growth is the amount, means we have sales 5 lakh in year 3 multiplied by growth rate 1.15 and 5,75,000 will be the sales. Simple, same as question number 19 is repeated question number 20, and question number 20 is only asking for the real growth, not nominal growth. Real growth is the base year multiplied by rate of desired rate of return growth, desired rate of growth. Here is 5 lakh multiplied by 1.15 means 15% we have considered here. Okay, now question number 21. I think this is quite lengthy, but we have to read technically this one. Okay, what is the, how can we solve this within the 1 minute, these questions? That is our purpose, that is our target, right? Which one of the following capital investment evaluation method would result in initial a recommendation of a less profitable project as better choice? Which of the following? Net present value, payback period, internal rate of return, accounting rate of return. Accounting rate of return is not considered for the capital decision making. Payback period. Which one of the following investment evaluation method would result the initial recommendation of less profitable project as better choice? Internal rate of return. Companies consider two investments. Both have an estimated useful life 5 years and require an initial cash flow of 15,000, and option A, option B, Z. Project A, project Z. Of project 5 years 15,000. Okay, this is option net present value. Simple. Okay, now in question number 22, all of the following items are included in discounted cash flow analysis except discounted cash flow analysis except the future asset depreciation expenses, future operating cash saving, tax effect, future asset depreciation, tax effect, future, and current asset disposal price. See what is question is saying. Discounted cash flow analysis. This is saying current asset disposal. Current asset disposal means what? We are disposing, we are selling now. How this will affect future cash flow? Discounted. Why need to make the discounted for this current asset disposal? Because we sell today, and no need to discount today. What will the discounted at? 0, right? This option D is the correct question. Question number 23. Question number 23 is Regal Industry is replacing a grinder purchased 5 years ago. I think this is repeated, right? Already we have calculated 70,400 previous question. This is repeated, and if you have not if you have joined recently, then you can back video, and earlier we solved this question. Same this question, this is repeated, so I don't calculate again this one. And when the risks of the individual component of the project cash flow are different, acceptable procedure to evaluate This cash flow is discounted cash flow using discounted rate that reflect the degree of risk divided each cash flow by the period, and compute the net present value of each cash flow using the form cost of capital. Compare the internal rate of return from each cell. Discounted cash flow using the discounted rate of degree. This one, option C. Okay. Now in question number 25, almost we have done all the questions. Now question number 25 is remaining. What is this? Discounted net tax amount that should be factors into Crane Company's analysis for the disposal transaction is what is given? Period 1, 2, 3, 4. 14% annuity is given. Yes, here annuity is given. These questions. Okay, let's do the question. On January 1, Carne Company will acquire a new asset that cost $400 and is anticipated to have a salvage value of $30,000 at the end of 4 years. It means annual depreciation what? 4 lakh minus 30,000 divided by 4. 4 lakh minus 30,000 divided by 4 is 92,500 annual depreciation become. Now this is the last question. On January 1, Crane Company will acquire a new asset that costs 4 lakh and is anticipated to have salvage value 30,000 at the year of 4 unit. The new asset qualifies a 3-year property under modified accelerated cost recovery system MACRS will replace an old asset that currently has a tax basis of 80,000 and can be sold now for 60,000 and will continue to generate the same operating revenue as old asset, 2 lakh per year. However, saving in operating cost will be experienced as follow: total of 2,20,000, 1,20,000 each of the first 3 years and 90,000 in the fourth year. Crane is subject to 40% tax rate and hurdle rate of computation to be nearest dollar. Assume that any gain or losses affect that taxes paid at the end of the year in which it occurred. The company use the net present value method, analyze the project using the following factors and rates: present value, period 1, period 2, period 4 at 40%, 0.188 per new period 1 and 0.77 period 2, period 3 0.68, period 4 59. Annuity also given the same. Annuity means sum of each year, and at a 14% MA CRS is 30, period 1 33%, period 2 45%, period 3 15%, period 4 7%. Discounted net tax amount that should be factored in to Crane Company's analysis for the disposal transaction is option A 60,000, option B 52,000, option C 67,040, option D 45,760. Let's check. This is net discounted cash flow net of tax. For this question, we have to first understand concept to concept, and then we have to solve the questions. This question is not that much easy, and we have to understand the concept first. Given that old asset given, okay, replace old asset, that tax base is how much? 80,000, right? That is 80,000 for what? That is used for calculation of tax purpose. 80,000. And selling price how much? Selling price is 60,000, and saving will be how much? 40,000. Okay, that tax rate is 40%. There is loss on sale of old asset how much? 20,000, and tax saving will be there on 20,000. and discounted rate of present value 40%, and present value discounted, everything is given. That is 20,000 loss, and there will be save of tax. And 20,000 loss means we can save on tax. There 4,000 will come the tax saving on that 20,000. Okay, no, 40,000. 20,000 multiplied by 40% tax is come to 8,000. 8,000 will be the tax saving. Okay, step 3, discounted the tax saving present value. What will the discounted tax saving? Discounted tax saving will be present. We have to calculate at present, means 8,000 present 0.88. okay, 7,040 tax saving present value come to 7,040. Additional cash inflow from the sale of old assets will be 60,000. Already received immediately, no discounted. Okay. Why we discounted tax saving? This is critical to think. While we sell the fixed asset, there will not be discounted, but tax saving will be discounted. Why? Because tax benefit will be received at the year end only. Even we sell the equipment today immediately, but tax saving will be available when we file the tax return. Then only tax saving benefit will be available. That is why we have to discount that amount 8,000 multiplied by first year discounted rate, that is 8.88 is come to 7,040. Okay, and total saving how much? 60,000 plus 67,040. And which option is correct? And how much is total saving? 60,000 plus 67040. This option, which one is correct? Option C. Okay, now option is C correct. Other option we don't go for other option. Let's submit how much is correct. Maybe 2 or 3 may be the wrong. I was confused that answer. No, there are 7 incorrect answer. Let's check detail. Total 72% score, and this is par percentage, but still there are 7 mistakes are there. Which one? This one, I don't know why this happened. And 1, 2, this one, there is no content rate of return issue. Oh, this was some confusion. This one, net present value, payback period. Okay, thank you so much for watching my live till now. I will back tomorrow for next topics, and we will discuss for next session.